Hello, everyone. Good afternoon. Good afternoon. For those who are joining live, good afternoon. For those who are going to be watching the replay, good afternoon. Thank you so much for joining me as I share with you a little bit about credit. Today, I want to talk about why your scores matter and the makeup of your credit score. Next week, I'm going to talk about things you can do to improve your credit score, because I want to keep these meetings no longer than 30 minutes because people are bombarded by so many things. And so I don't want to go an hour or more because I want people to be able to consume the data, to be able to consume the information, and be able to apply it. But I think if it's going to be too long, people are going to probably just watch a part of it and just move on. So I want to keep it no longer than 30 minutes. And I'm talking because I'm waiting for people to join, because I want to get to be able to start sharing when we have people here, even though I know people will be able to access the replay. So again, I want to welcome you to this discussion on credit. And my name is Severin Bryan of sevtalksmoney.com. Again, my name is Severin Bryan of sevtalksmoney.com. That is my website. So I want to start off by talking about why credit. Why does it matter if you have a credit score? Now, this broadcast, this information is not for anybody who has the cash to buy a house outright, the cash to send your kids to school, all the way up to a PhD or to a professional level, whether a lawyer or a doctor. If you have the cash to pay for that, this broadcast is not for you. If you have the cash to buy a car, a house outright, this is not for you. This is for those people who need to be able to navigate the world, the financial world, with credit, who need to be able to have a good credit score to get good interest rates on credit cards, etc. With that said, why does credit matter? Why does a good credit score matter? When we apply for jobs, depending on the type of job, they are more than likely to pull your credit score. They're more likely to pull your credit score. Whether that's fair or not, they're looking at your credit score as an indicator of your faithfulness. They're looking at your credit score as an indicator of how you will handle your job. A credit score is simply a number. Let me backtrack and just say what a credit score is first. A credit score is a 3-digit number that, first of all, FICO started, which is a Fair Isaacs company, started. And what it's doing is it's analyzing your payment patterns and other things related to your financials to come up with a number to say this person, because of this number, is a credit risk. And we're all credit risks, but some of us, the credit risk is higher or lower. And then the three main credit agencies, Equifax, Experian, and TransUnion, came up with the Vantage score, which is similar to FICO. And basically all it's doing is just looking at your payment patterns and just saying, what kind of a credit risk is this person? How likely is this person to pay me back if I loan them money? How likely is this person to steal from me if I hire them based on their past credit behavior? And so those agencies, and by the way, there are hundreds of credit scoring models. We hear about FICO. Even within FICO, there's over 50 credit scoring models. So there are different types of credit scoring models. And next week, I'll talk a little bit about how you want to use the when you go to a lending agency, how you want to use the credit scoring model, or how you can let it work for you. So we'll talk about that a little bit next week. So going back to why credit matters in this world that we're living in. Jobs pull your credit. For insurance, auto insurance, they say they don't use your credit to determine what they charge you. But if they don't, why do they need to pull your credit score? Why do they need to pull your credit? I had one instance where when I first walked away from a house years ago and my credit was in the 600s, and I got my auto insurance, and then when my credit got up into the 700s, I called them and I say, hey, when I first got credit with you, my credit was in the 600s. Now it's in the 700s. So you should be able to give me a better deal. And they said, well, we don't use your credit score to give you the rates. I'm like, well, if you don't, why are you pulling my credit? So they tell you they don't, but based on my experience, there's something they're using on your credit to determine what you should pay. Otherwise, why pull your credit score or pull your credit? If you're going to buy a house, a car, applying for credit cards, all of those, they're going to be pulling your credit score. They're going to be pulling your credit to determine what kind of interest rate they give to you. So those are some of the reasons why credit matter. It just so happens that this is the world we live in. And so fair or not, they are using what kind of credit you have. They're using that as a way to determine your future behavior. They're using your past behavior as a way to determine how you're going to behave financially. Now, let's talk a little bit about the makeup of your credit score. There are 5 components of the FICO credit score. There is, for the Vantage score, these are not the same factors that go into the Vantage score. So when you run like a Credit Karma or Credit Sesame, you're using Vantage, and the measures that are used for Vantage is different from what is used for FICO. And again, FICO, it comes from the Fair Isaac company. That's where FICO comes from. So the first part and the biggest part of your credit score is your on-time payments. 35% of your score is made up of on-time payments. That means if you don't pay, if you pay everything on time and one thing is late, it is possible to drop your score over 100 points. And as I spoke earlier, when I walked away from my house because I got a divorce and all of that, just a lot of things that came with that. When I walked away from my house, I stopped paying because I rented somewhere else and I did not want to pay 2 places, as my lawyer advised, to go ahead and rent somewhere to move out of that house. And so I did. And my credit score dropped over 100 points because I had stopped paying on my mortgage. Everything else was current. Some things were ahead of time, but it didn't matter. I stopped paying on my house, and so my credit score dropped. Thankfully, it's climbed back past where it was before. Credit utilization is 30% of your score. That means if you have a credit card that is $1,000 and you are using $900, that's 90%. The conventional wisdom is that 30% of your score, you should not use more than 30% of your credit. But I would suggest even lower, 10%. And here's something you can look at in order to manage your utilization. Again, the 35% on time, basically all you got to do is pay on time. There's really nothing much you can do other than just paying on time. For credit utilization, one of the things that you can do, because it's a big part of your score, it's 30%. Between on-time payments and utilization, that's 65%. So what you can do for utilization, if you decide to use your credit card, for example, you pay that before the statement date. Learn when your statement date is, because when your credit card issuer reports to the agency is after they've created your statement and they send and say, hey, this is the balance on this person's credit report or this person's card, right? So 30% of your credit score is made up of that. So what you want to do, because if you don't know the rules of the game, you can't play the game. Okay? If you do not know the rules of the game, you cannot play the game. Or you will try to play the game and you will lose every time because you don't know the rules of the game. So 30% is utilization. What you can do is, if you know your credit card statement always come to you on the 5th of the month, you pay your credit card statement on the 4th. So when they report to the credit reporting agencies, they're either reporting zero or a very small number. So if you have $1,000 in your card and you know, hey, I want to use this card to maybe get cash back. I'm not cash back. You want to get cash points where they will give you cash based on how much you spent. Or you want to get points for travel, and you know that you want to put your charges on the card so that you can get those points for travel. Well, you know your credit card statement come out on the 5th. What you do, you pay on the 4th, and you leave a tiny amount there on the card so they can report, hey, my balance is $10. They can report that if they want, because it's going to show that if you have $1,000, let's say you have $1,000 and the balance that you're leaving on there is $100, that's 10%. And that's fine. That's not going to have a major impact on your credit score. But if you left that whole 900 there so that by the 5th, when they report, you're going to have a 90% utilization, that's going to have a major negative impact on your credit score. So you play the game. You use the card if you know how to manage it, but you pay that before the statement date. Notice I'm not saying before the payment date, but the statement date. Because when they send the statement, when they do that cutoff, is when they send the amount to the credit reporting agency. For your student loans, if you want to chop down your student loans, and it's typically at the end of the month, and you can call your agency and you can ask them, when do you usually report to the credit agency? Typically, it's at the end of the month. So even though your payment for your student loan might be, say, the 19th of the month, and you know that they're going to report at the end of the month. So the 19th, when they send you their statement on the 19th of January, that statement is due on the 19th of February. Okay, stay with me. If they send you the statement for student loans on the 19th of January, it's due on the 19th of February. So that payment, that amount that's on your student loan is already reported for January. But when they do the next report, if you want your student loan to reflect or to boost your score by paying it down, if you have, let's say you got a $5,000, you want to pay that before the end of January, because when they report, if your student loan servicer reports at the end of the month, you want to pay that at the end of January. So when they send their statement to say, hey, at the end of January, this is their balance, that amount, that big amount that's on there that you paid, will positively reflect on your February credit score. Okay? So does that make sense? If your student loan servicer reports on the 19th of January, send you your statement on the 19th of January, and that servicer, their reporting date is at the end of the month, you want to pay before the end of the month. You don't want to wait until February 19th because that's when it typically is due, because they give you 30 days. So you don't want to wait until the end of until the date when it's due. You want to pay before the end of the month if that's when they report. But it all depends on when do they report to the agency. So you want to manage that. Manage the reporting period. Your credit card company typically reports on the date of your statement. Your loan servicer typically reports at the end of the month, but you verify that and you pay before that period so that you don't have a large amount that's reporting on your credit report, which subsequently impacts your credit score. All right, the next category is your credit history. And again, next week I'll share some things on what you can do to increase your credit score. But pretty much, for the most part, you can't do anything about your history. If you have 5 years, you have 5 years. You can't magically make it be 15 years. But again, there's some things that you can do, which we will share next week, to increase your credit score. 10% is your credit mix. And actually, before I go to credit mix, let me kind of give you an example of how to look at your credit history. Okay, let's say you have a credit card, and you've had it for 10 years. Well, your credit history is going to be 10 years, right? If you decide to get a new card, your credit history now becomes your credit age. I should say, not credit history, your credit age now becomes 5. And here's how they calculate that. You've had a card for 10 years, so your credit age is 10, right? Which is good because it's showing that you've managed credit for 10 years. But even though it's only 15% of your score, but if you can manage the next 3, credit history, credit mix, and hard inquiries, if you can manage that well, between those last 3 is 35%. So you can still do a little thing. You can do something to help your score. The first 2, yes, if you've missed a payment, it's kind of hard to get back on time because that one missed payment will report for a long time before the impact goes away. And the same with utilization, right? But credit history or credit age, if you apply for new card, now you have a card that's 10 years and you have a card that's 1 month. They're going to add the 2. So now you have 10 divided by 2. If you applied for 3 loans or 2 more loans apart from the one that you have that's 10 years old, now you have 10 plus 1 month plus 1 month. And they're going to divide that by the 3. So now your credit age is going to be 3.3 years. So be cognizant of that when you are applying for a new line of credit. Be cognizant that if a new type of credit is reported on your return, on your credit report, that is going to decrease your credit age. Now, credit mix, of course, as it says, it's just a mixture of, do you have loans, car loans, and credit cards? Do you have student loans and car loans? And what is your mix that you have? That's basically what that looks at. And the more of a mix you have, the more you are your score is positively influenced. And then 10% is hard inquiry. So again, 35% is on time, 30% is utilization, 15% is credit age, 10% is credit mix, and 10% is hard inquiries. Now, hard inquiries, this is where you have asked an agency, you've asked them to extend credit to you. Some companies, if you already have a relationship with them, they will do a soft inquiry. And a soft inquiry does not appear on your credit report that's pulled by external companies. You are the only one that sees soft inquiries. For example, Capital One is a company where if you already have a relationship with them and you ask them to maybe increase your line of credit, say your credit card is 1,000, you ask them to increase it to 2,000. Capital One is one of those that will do a soft inquiry. So you don't have, it won't show up on your credit report and it won't impact your credit score. A hard inquiry is if you were to ask for a mortgage from a company that you don't do business with, or maybe even Capital One or some other company. If it's a large amount, yes, they're probably going to do a hard inquiry. And so that is going to impact your credit score by 10%. After about 12 months, the impact is less, but it's still, 10%. The impact is going to be less on your score. And after 2 years, the hard inquiries drop off of your score. So again, the hard inquiries are going to drop off your score. Your missed payments are going to be for, you're on time. If you're not on time, if you've missed payments, it's going to be stay on your credit for 7 years. Now, of course, there are things that you can do and talk to the creditors, which we won't go into because, again, as I said, I want to keep these sessions no more than 30 minutes. So next week, we'll go into, the things you can do to improve your credit score. Next week, we'll talk about some of those things, and we will talk about those in relationship to the different FICO credit factors. Another thing that I want to touch on real quickly before we wrap up this session is Experian Boost. Experian Boost is something that you can use to boost your credit score. But I want to give some caution, okay? What they're doing is they're looking at your payment history for utilities and telephone. And they're going to Experian, not they, Experian is going to go into, you have to give them access to your bank account. And they say they're not seeing your numbers, you're not going to be able to take anything out of there. They're basically going to get a scan of your data, is what they're saying. But personally, I don't want anybody going into my bank account. So I don't give anybody access to my bank account. But anyway, this is how it works. Experian will, you give them access to your account and they will scan your payment for utilities and telephone, and based on your payment history, and if you're paying on time, it will boost your Experian score. All right, here's the thing though. If you're trying to apply for a loan and your lender is using TransUnion or Equifax, Experian Boost does not help you. So if you're going to do Experian Boost, be sure that you know what lender you're using and whether or not that lender uses Experian. And hey, Linda, check to make sure to verify whether or not your lender is going to use Experian, because it's a waste of time to use Experian Boost if they're not going to use Experian. Here's another thing to consider. Each scoring model is always updating. A lot of lenders are only using the older one. For example, FICO is now up to FICO 9. Vantage is now up to 4, Vantage 4.0. Lenders may be using FICO 5, which does not factor in Experian Boost. FICO 8, as of now, FICO 8 is the only one that uses Experian Boost. So if you're going to, let's say TransUnion is the report that they're going to pull from, the agency that they're going to pull from, Experian Boost won't help you. If they're even using Experian, but they're using the newest Experian, the newest FICO, okay? Because remember, Experian is only the reporting agency. If they're going to pull from Experian, but they're using the FICO 9 model, Experian Boost is not going to help you. So yes, Experian Boost can help to boost your score, and typically it's no more than maybe 19, 20 points for somebody who has a very slim credit history, very slim credit portfolio. Experian Boost might help you. But again, if your lender is not using Experian 8 and not using FICO 8 model, it's not going to help you. So keep those things in mind. So again, I just want to do a summary of what we discussed. And then next week, as I said, we will talk a little bit more about the things you can do to improve your credit score. So the first thing I talked about is what is a credit score? And again, a credit score is a three-digit number that FICO, which is Fair Isaac's company, and Vantage, which is created by the three major credit agencies, created those score models because they wanted to use that, and they do analysis of your spending pattern, your payment pattern, and other things to determine how credit worthy you are based on your history. How likely are you to repay your loan? So that's what a credit is, a three-digit number. And different models have different things. I mean, it could go up to 850 on some models. It could go up to 900 on some models. And again, just be aware that there are different models of credit score. So when they say FICO, it's not just FICO. It could be FICO 9. It could be FICO 8. It could be FICO 5. When they say Vantage, it could be Vantage 3. It could be Vantage 4. And there are others. There is a real estate model. There are all kinds of scoring models. So beware of that. Ask your lender. Ask your lender if you're going to apply for a loan. Before you even apply, say, hey, what scoring model do you use? So you can kind of figure out which one you want to concentrate on making increasing, or which one you want to concentrate on so that they can get a good credit score for you. And the next thing we talked about is why even be concerned about credit scores. And that's because jobs are using your credit scores. You could possibly lose. People have lost jobs because their credit score is not up to par based on what the company is expecting. People have gotten job offers, and when the credit report was pulled, they lost the job. They lost the offer. They took back the offer because their credit score was not up to par. Insurance companies are pulling that information. If you want to buy a house, a car, if you want to request a credit card, though they are using your credit score. They're using your credit to determine how credit worthy are you. So you want to be cognizant of that. And then the next thing we talked about was how credit scores are made up. 35% comes from on-time payment, 30% from utilization. How much of the credit that was extended to you are you using on a regular basis? And we talked about, the fact that you have to know the rules of the game to play the game. If you know that your credit, they're going to report at a certain time, you pay before the report date, not the payment date, but the report date. So you can use as much of the credit as you want, as long as you pay before that report date, because that won't reflect on your report and it won't negatively impact your credit score. And that's why people say all the time, you can use credit cards to fund your business, but you've got to know how to do it so that when it's time for reporting, you took $10,000 out on your credit card to do something and you pay it before the report date. That's not going to be reflected on your credit report. And that's not going to negatively impact your credit score because you know the rules of the game and you can play the game. And the next thing we talked about was the credit age and the fact how it's calculated. If you have a credit card that's 10 years old and you decide to get a new one, now your credit age is not 10 anymore. Now it's going to be 5 because it takes the total age and divide it by the number of cards or the number of credit. And your credit age is now 5, and that's going to negatively impact your credit score because that's 15% of your total credit score. And then the last two things we talked about, 10% of your score is credit mix. It just simply means, as it says, do you have car loan and a mortgage, credit cards? What is the mix that you have? And they like to see a mix. First, I just have 2, and my score is still in the 700. So it's not so much that you have to get a whole heap of things to let your score climb. Because again, this is only 10%, but it would be good to have at least 2 different types of credit on your report. And the last one is, of course, the hard inquiries, which is where you are asking for loans from an agency. The hard inquiry stays on your report for 2 years. and it eventually drops off. After 12 months, the impact is not as great. Soft inquiries are where companies run reports on you. You're already doing business with them, and they run reports on you to determine, let me see what she's up to. Should I extend her the offer to maybe get a new card? Should I? Because I get those all the time, and that's because I know the companies that I'm doing business with running soft inquiries. When you suddenly get an email to say that says, "Hey, we have this new card, and it's a gold card or the silver card or whatever it is, and we want to offer it to you," that's because they've run a soft inquiry on you. And they look at what you're doing, and then they'll send you. That does not report on your credit report to anybody but you. You're the only one that see that. And then at the beginning, I talked about the fact that if you have cash to pay for a house and a car and your children's education, then this discussion is not for you. This is for people who don't have the cash in hand, but they're wanting to learn how to manage their credit so that their credit score is not showing a low number. Because a lot of people have good payment patterns, and they have a low credit, not so much because any of those factors are bad, but they just don't know how to handle those factors to make sure that their credit reflect positively, or that they have a good credit score. And again, as I offer before in all of my discussions, you can go to my website if you want to talk more, if you want to show me, get a plan together to get your credit in order or anything like that. In Georgia, I cannot fix your credit. I cannot do credit repair in Georgia. It is illegal for me to do credit repair in Georgia. So if anybody outside of a lawyer or a related to real estate or a nonprofit offers to do your credit repair in Georgia and they're charging you money, it is illegal. Don't pay. Okay, just want to give you that information. So I can't fix your credit report. I cannot fix your credit in Georgia, but I can talk to you and I can show you different things that you can do to fix your own credit. So again, my website is sevtalksmoney.com. Go on that website, and you can always send me an email. Make an appointment. There are appointment slots on there. You can go and make an appointment if you want to discuss further things that you can do to things you can look at for any of these things that I've discussed. And again, next week we'll talk about things that you can do to improve your credit score. Tips and tricks that you can do to improve your credit score. Again, this is Severin Bryan with sevtalksmoney.com. Thank you so much for those who joined live. Thank you to those who are watching the replay. And I hope that this was information that you can use in your everyday life. Share with your family, share with your friends, and you can even share this broadcast with them. But share with them the information so they can know that it's all about knowing the games. And again, as I said, rich people use this system, okay? They know the rules of the game, and they use this system, and they use this system to advance. And I want my people to know the rules of the game, because if you don't know the rules of the game, you cannot play the game. So thank you so much, and thank you to those who are going to be watching on YouTube. Thank you to you also for watching, and please share. Subscribe to my YouTube channel for those that are watching via YouTube, and for those who are on Facebook, you can go to my business page, Bryan Financial Empowerment LLC. That's Bryan Financial Empowerment LLC. You can follow there, and you can get update when I go live. I typically do this every Sunday afternoon at 4:30, but there are times when I may do some pop-up live. So if you follow me there, then you will get the notices when I do lives. So again, thank you to those who joined live, and thank you to those who are watching the replay. Thank you to those who are watching via YouTube. Have a wonderful and blessed day.